Hey folks, Mike Gray here, and today we're going to talk about one of the questions that I get asked almost on a daily basis, and it's about interest rates. So I brought in an expert, Chris Sizemore, president of Gibraltar Mortgage. We're going to talk about kind of where things have been, where they are, and what we think is going to happen coming up in the future. So Chris, thanks for coming in. Definitely appreciate the insight.
Absolutely, great to be here. Well, if I had a crystal ball, I'd be able to tell everyone that rates are going to drop back into the threes and the housing opportunity will blow up, explode, and everybody will be back in the market looking for new homes to buy and be ready to sell their home. But that being said, it's probably not likely to happen this year. The Feds, are projected to cut rates 2 times this year at least. And let me tell you what happens when you hear about the Feds are meeting, the Feds are going to cut interest rates. That interest rate cut that they make is generally the place that you'll see it first is going to be in your credit card loan, your car loans. If you're buying durable goods like washing machines and dryers, those interest rates on those types of short-term loans do get impacted quickly and easily, and they go down by the quarter percentage point that the Fed rates cut. Mortgage rates, you can really track this if you wanted to without getting too deep by looking at the 10-year Treasury note. Just Google 10-year Treasury. Today, when I walked in here, it was at 4.53. Generally, you can add 2 points to that, to 2.25, 2.5, and that tells you where the prevailing mortgage interest rate is today. So for example, if it was 4.53, add 2 points to that, 6.53 to 7% would be the interest rates, and that's where we stand today.
So saying that, great information. We are projecting, or they are projecting a couple drops this year.
Mm-hmm.
Does that mean are you thinking 2 quarter-point drops, so maybe a 0.5 point throughout the year? Is that what we're thinking?
That's right.
So we're getting better. Longer term, you mentioned the 3.5. I'm not expecting that to ever to come back in my lifetime.
Right.
I think we're in let me ask you, are we in kind of a window of where we are moving forward for at least the foreseeable future?
Well, the mortgage bankers forecast comes out annually, and their forecast for interest rates is 7% in the first quarter, which I just kind of gave you an illustration that showed we're at about 6.75% to 7%. By the end of the year, 6.5%. Now things can change. Geopolitically, things can change. That could be a really big catalyst. We've already heard the president say, he wants to do something about interest rates. Obviously, real estate is a big driver of our economy. A lot of jobs are impacted on real estate. A lot of families are very involved, and so that's something that he's got his eye on. And we need to get prices under control across the board. So you hear about inflation. If they continue to get inflation down somewhat and prices are easing at the grocery store and the everyday things that families have to spend their money on, that's going to certainly help housing, because then they can afford to make the next step up or buy that first home and afford that payment.
So let's segue off of that. Let's talk about affordability. Right now, we have a lot of things that are creating housing being unaffordable: insurance costs, taxes, rates. What do you see as affordability moving forward? And I guess the 1A question on that, at what interest rate do people feel comfortable moving forward, not being locked into the 3% mortgage moving up? What's that number where things really start to move?
Well, we're already seeing people have started to acclimate, because it's as much psychological for people who for the last 5 years prior to around 2020, 2021, and 22, they've seen rates in the 3s to 4% range. They made a sudden and drastic increase in 22, and that changed everyone's thinking and hoping that rates will come back down into that range. That's not really in the forecast. So I think it's a few things will continue to happen. Number one, new families will form and need a bigger house. Number two, unfortunately, families will get divorces and sell their home. People still get married and buy a new house, and people still pass away and sell their home. So looking for that affordability piece, the important part is the difference in a 6.99% interest rate and a 5.5%, for example. I think that's probably the key number, getting an interest rate into the 5s. And here's why. At 6.99%, and the average loan amount here in the Houston market is about $320,000 is what I've used for this illustration. So the difference in a payment on 6.99% versus 5.5% is $311. that makes a difference for a lot of people, especially first-time home buyers, which are a big driver. In addition to affordability, I have a chart that's going to be displayed, and it shows the history since, I think, going back to 2017. In the last year or so, inventory levels have increased. As a matter of fact, in the Houston area market alone, there's over 32,000 homes available. So the inventory has been well below that. There's only been 1 month's supply, 2 months supply. An average supply for homes is about 5 to 6 months. And I think as we get closer to that, a couple things will happen. Hopefully interest rates will come back down to increase affordability somewhat, but prices will stay flat more than likely. Now that's just my opinion, but if you look at the numbers, increased inventory and lower rates will stimulate more buyers into the market.
So there you have it, folks. We think that rates are going to stay pretty steady, but if you look historically, rates are good now, depending on what you compare it to. If you look at the history, rates are very good. If you look at the 2.5 and 3 that was really artificially held down for a little while, they don't look good. But again, it's normalizing, and we've talked about the lock-in effect where sellers don't want to get rid. That's starting to move a little bit more. Again, more inventory is coming to the market. So we're very pro on this year. We think that Houston, Texas in general, is more of a gradual market. During COVID, it was just off the charts. So we're going back to a normalized market. So Chris, thanks for coming in. Great information, appreciate it. Good luck this year.
I do want to add that one thing Mike and his team can do, whether you're listing your home for sale or buying your home, is negotiate discount points. As a seller, you can provide discount points to buy the permanent interest rate down. We can help you obviously with that, pricing that, but that's a way to market your home if you want to. For example, if the prevailing market is 6.99 and you offer to buy down with points, which is 1% of the sales price. So a $500,000 sale price, for example, would be 1% would be $5,000. But that could be used to permanently buy down the interest rate, and then you can market that to your clients, to the market, to buyers, potential buyers, to be able to help you sell your home. From a buyer perspective, for affordability, you can ask for as part of the negotiation, and Mike's great at that, would be, have the seller contribute to buy down your interest rate. So yes, the prevailing rate may be in the high 6s, but you could buy down easily for up, to get into the 5s as well that way. There's all kinds of ways to get there.
It's all math, and sometimes the math works out better in that for a seller than just reducing the price. So tools in the toolbox. So again, thanks Chris, appreciate it. And folks, we'll be back. If you have any questions, reach out on mortgage or on your housing needs. Thanks again, we'll talk soon.